Will 2025 be another bull run for the markets? Or is a major correction on the horizon? With Trump's renewed trade wars, the sticky global inflation, and AI's trillion-dollar hype facing its first real challenge, the stakes have never been higher. We put two of the most powerful AI models to the test, asking them to analyze the biggest risks for financial markets in the current environment. What will their prediction be? Stay tuned to find out. And make sure to stick around until the end. I'll share how I plan to use this information to adjust my own trading strategies. The R1 model from DeepSeek and O3 model from OpenAI are the two most advanced analytical models, which use a chain of thought reasoning to solve a problem. A chain of thought is the step-by-step reasoning process that an AI model uses to solve complex problems, similar to how humans break down a question into smaller logical steps before arriving at an answer. We input the same prompt into both models, asking them to search the internet for relevant data, analyze the key risk factors for the market in 2025, and estimate the probability of a market correction. Additionally, we want them to assess the potential magnitude of the correction based on their analysis, and to give us a clear breakdown of their reasoning, so we can follow their logic and learn from the process. We wait for both models to complete their reasoning steps and generate results. One way to analyze the outputs is by manually reviewing each step, reading, and interpreting the information. A smarter way, however, is to use an AI assistant in this process. I'm using Google's Notebook LM service, which allows interaction with documents by uploading various sources and querying them directly. Here's how it works. I've copied and pasted the responses from both models into separate documents and uploaded them into Notebook LM. Now I ask the model to highlight the similarities and differences between their analysis. Let's look at the similarities first. Both models categorize the risk factors into similar areas, including macroeconomic trends, geopolitical tensions, and sector-specific threats. And both models acknowledge the possibility of a market correction. The US inflation remains stubbornly above Federal Reserve target of 2%. As a result, Fed has already adjusted its policy, scaling back its plan for 4 rate cuts to likely only 2 for this year. Why does this matter for the stock market? Well, higher interest rates make borrowing more expensive, leading to lower business investment, reduced consumer spending, and weaker corporate growth. Additionally, it means less liquidity in the markets, which puts downward pressure on stock prices. Another warning sign comes from the bond market. Normally, long-term bonds offer higher yields than short-term bonds because investors demand more return for locking up their money longer. But right now, short-term rates are higher than long-term rates, signaling economic stress. If we look at the spread between the 10-year and 1-year Treasury yields over the past 50 years, it's clear that we've been in this red inverted yield zone since mid-2022, which is the longest in history. We can see that historically, every major market crash has been preceded by a period of yield inversion. While a crash hasn't happened yet this time, history suggests that this can be a major risk factor for the whole economy. Another risk factor that both models mention is the geopolitical tension heated by the newly imposed US tariffs on imported goods. Why is that a threat for financial markets? Because tariffs make imported goods more expensive. Some estimates say tariffs could add another 1% to inflation, which could force the Fed to keep interest rates high for even longer. And if major economies retaliate, global GDP could shrink as a result and put lots of pressure on the global stock market. Ironically, both AI models warn about the risk of an AI bubble in the markets right now. The recent stock market rally has been driven largely by mega-cap AI companies. In fact, the top 10 companies in the S&P 500 now make up over 34% of the index, exceeding the concentration levels seen during the dot-com bubble. It started to show its vulnerability when DeepSeek from China shook up the space by offering high-performance models at a fraction of the cost of US competitors. If AI growth fails to meet sky-high expectations or competition intensifies, tech stocks could face a major sell-off, dragging down the broader market with them. Both AI models agree on the key risk factors, but they disagree on the likelihood of a downtrend happening. O3 gives it a 40 to 50% chance, while R1 is much more cautious, predicting 70 to 75%. The cool thing about chain of thought reasoning is that we can actually follow their logic and see how they got these numbers. Since we also explicitly ask them to explain their logic in the prompt, we can break down their thought process and compare their reasoning. We see that DeepSeek cross-referenced the main risk factors with different expert projections. It also looked at technical analysis and historical patterns to map out potential downside scenarios. At the end, it factored in expert opinions from major analysts to weigh the probability of different outcomes. OpenAI followed pretty much the same process. Both of them are weighting in different analyst estimates in their predictions. Probably depending on which reports they pick and how they factor that in the calculations, the results can be different. If you have access to these models, try it out yourself. Run the same analysis and see what scenarios you get. Drop your findings in the comments. It'd be great to compare. I've also linked the detailed analysis with the prompt in the video description. Check it out if you want to dive deeper. Now let me share how I'd use this information to adjust my strategies for the rest of the year. The key takeaway from the AI analysis is that the market is packed with major uncertainties right now, which means we're likely to see more volatility and sharp swings in both directions. In this kind of environment, I think it's smarter to take a less directional approach with equities and instead lean into the elevated volatility by trading options. It's a way to make profit from the expansion of volatility in the downtrend movements without risking directional exposure too much. I also need to tighten up my risk management. That means scaling down trade sizes and diversifying my portfolio further, possibly by adding Treasury Bond ETFs to the mix. Bonds can bring some much-needed stability and balance, which feels like a solid move when the market feels so unpredictable.